Welcome to the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy such as the Deferred Sales Trust is the best way for you to grow your wealth. I'm your host, Brett Swartz, and each episode I am joined by some of the best real estate, financial, and wealth minds in the world, where they share their ideas, deal stories, and inspiration. So together we can make complex tax deferral strategies simple and passive income plans achievable. Hey, I'm excited about our next guest. He is the Chief Executive Officer and President of Griffin Living. And he actually founded the company in 2009 and has since overseen all aspects of its growth, from a regional developer in California to an award-winning, nationally recognized firm with properties across the United States. Prior to founding Griffin Living, he oversaw the development of a wide variety of projects, including award-winning senior living residences, multifamily residential homes, apartment complexes, retail centers, and commercial office space. He has developed over $4.5 billion in assets over the course of his career. Please welcome to the show with me, Paul Griffin. Hey, Paul, how you doing?
Good. Thank you for having me. It's lovely to be here.
Excellent. And would you give our audience just a little bit more about your story and your current focus?
Certainly. I'm come from a long line of real estate developers, and the best kind of guys. I'm the fifth generation of my family to be in real estate development in California. During that time, we mostly focused on master plan communities and for sale housing. In a master plan community, there were, we always had apartments, multifamily that we kept for our portfolio, and would later sell them and deal with the tax implication and how to have our investment continue. The neighborhood shopping centers, of course, the tax credits in developing the schools that went inside the master plan communities. So, there was always a lot going on, a lot of fun. I love the business. I appreciate my forefathers that brought us into it, and I came into the Griffin family has done something in the neighborhood of communities that consist of about 40,000 houses, and something in the neighborhood of about $12 billion in asset value, all in. And then I've come in. Started working about 40 years ago now after college. It's been a bit, and date myself here. Took over a family business myself as a CEO and the stock, and bought my dad out of his shares and all in about 1992. And I think I paid my dad off in 1996, and then his share of the profit by 2000. So it transitions. In any event, in the time that I've been running master plan communities, or in the last 10 years really focusing on senior communities, my group has developed something in the neighborhood of $4 to $4.5 billion in assets. So quite an active company. We've enjoyed it. You have to love the business, and I do. My poor wife's, she says, "Dear, when are we going to retire? I want to move to the beach, and I don't want to be, living in out in Westlake and working in Calabasas. And what are we going to do?" And I think, goodness, it's just that I love what I do so much. There's such a passion for it. So, I think in the realm of find something to do that you would pay in order to be able to be involved with, that is real estate development for me.
Truly remarkable and an amazing story, and I can't wait to dive into the full interview with the history of the family and go into the different product types that you just discussed, and of course how COVID-19 is affecting those things and how you've pivoted into that, into the kind of the new world here. But in the meantime, would you touch on just maybe the biggest frustration or challenge that you've had over your career? And maybe it's a partner, maybe it's a friend, maybe it's a family member when it comes to capital gains tax deferral. In the context of syndication or partnerships, what's the biggest challenge that you faced?
One of the government changing the rules is one huge challenge. Of course, we all know that. What will happen in California? California's pretty broke, and there's only, we sort of know who the sources of money are going to be, and it's us that are working and have any assets. So I'm, a little bit worried about, what the future will bring here. I think, overarching that, one of my larger frustrations is because we're, a family business, I have aunts and uncles and nieces and nephews and different groups, which are, great to work around. My children and nieces and nephews now that are working their way up are all, well-educated, Harvard, Stanford, Oxford, MIT, Chicago, and they're driven and pushing us up and out of the way. So as they can, sent them out to work at other companies to learn and gain experience from other people. But that part of a family business is great. They will push me out of the saddle and take over. The other part is the older members of the family that aren't necessarily as involved and have different interests, their wives and their kids. When we put them into partnerships, LLC ownerships into our income properties, as those income properties become fully depreciated and it's time to, either recapitalize them by putting more investment in so that we can start the depreciation clock again, or deciding the depreciation's done, let's switch to another asset that we feel better about putting more development money in to start the depreciation clock again. Sometimes they get in the way and don't make rational decisions that we wish they would. But we love our family first. Of course, I would never want a problem to come up inside our family, and it never has. But your partners are something to consider. When the family, it's always, of course, a little bit more to think about. In terms of the in terms of the government and the capital gains, one of the bigger frustrations we have is, first we want to shelter ordinary income that we have and move the asset value increase, appreciation, if you will, to capital gains level taxes. So how can we get the development done? What's our basis in the development? What's the value of the asset when it's completed, hopefully more than the cost of the development itself? And then managing it over time using the depreciation against other ordinary income. So which ordinary income, which ordinary losses? We had a big project up in Monterey that I think we had about $14 million in it. And finally, even with the approvals, we decided to abandon the project due to the lawsuits. It's a hard decision. It doesn't happen very often, but it was huge master plan, apartments and shopping and everything else in it. But it does happen. So now the question is, how can I use, 14 million feels like a dead loss. It's cash that went in. How can I use the loss? And in the business we're in, generally against asset appreciation later in the business. So I have to sell an apartment complex with a tax gain to start to shelter my losses, those kinds of losses. So it just feels so much like a lot of hurdles to always navigate through.
Absolutely. Thank you for
sharing. Sorry, I talk on and on. Please feel free to interrupt and redirect the conversation.
No, Paul, it was fantastic. And you touched on a couple of different things there, which are really interesting, right? So the different partners have different interests at different times in different stages of life, and whether it's family yes. or friends or whomever it might be, we always want to take care as best as you can to serve everyone's interest in the best way possible. But unfortunately, sometimes the whole entity must move, and different people have different timing aspects of different things. And so what we found for a lot of these syndications or partnerships is, A, not everyone wants to do a 1031 exchange. B, people want liquidity, might want to go a different way, might want to diversify, may want to start their own thing. And so having flexibility and freedom for these things helps quite a bit. That other part of it with the carry forward loss is also interesting as well, right? And knowing that, when you do have a loss, although it's a huge, it's a painful, you put all the time, sweat, blood, and tears into that Monterey deal.
It's part of the business.
Yeah, yes. Part of the business. But you can offset it in the future with future gains, right, as you take it. So that's really great. And the last part you put with the depreciation schedule, right? One of the best reasons to own real estate is for the depreciation to offset the income that's coming in. But eventually, if you own multifamily 27 and a half years, it's 0, 39 years commercial, and then you're at a 0 depreciation schedule. That means all the cash flow that's coming is getting taxed. So you're like, oh, what do we do? Well, you can either improve it and get some more, or again, try to go buy another new property. And but the key is, how do you reset that? And so we'll have a good discussion on the full interview coming up here, because I have some thoughts for you to kind of bounce off with you there. But that being said, if folks want to connect with you right now, Paul, what's the best place for them to find you?
If you would like to send emails or contact at media@griffinliving.com.
Perfect.
That will be my assistant. Will read those and bring them over to me, and we will respond to you. If somebody sends us a note, we will respond.
Perfect. And then, by the way, if you're hearing this podcast and you're hearing those challenges, reach out to capitalgainstaxsolutions.com and our company, and we can give you some clarity on some options that might be available to you. Thanks, everyone.
Perhaps other people may even call in or have better ideas than I have and say, "You're missing it, Griffin. I got a better idea." I'm all ears.
Absolutely.
Yes.